Hey everyone, so this week's episode of Orange County Housing Market News is going to be a little bit different. So if you follow me on my other social media platforms, you've probably heard me over and over again over the last couple of weeks talking about this new Dream for All loan program. It's the hottest loan program that I've heard about since being a real estate agent, and rightfully so. It gives first-time homebuyers 20% down to be able to purchase a new home. However, this program was so popular that it ran out of funds before I was even able to get this episode out. The funds only lasted 10 days when originally California thought it was going to last till the end of summer. So I am still putting this episode out for a few reasons. So number one, there's a lot of good information about this loan program, and even though the funds have run out, there is a chance that some of these funds that have already been reserved for homebuyers in escrow might again become available if those homebuyers fall out of escrow and decide not to buy that property. So it's still something that you might want to look into when you talk to your lender over the next month or two to make sure that these funds are absolutely gone. As well as California has already stated that because of the interest in this program, there might be some additional funding coming. It might not be soon, but it's something that I'm going to keep on this channel. That way, if it does become available again, it's a great resource to know everything about this program. So in today's episode, I sit down with Mina from Guaranteed Rate Affinity, and we're going to go over everything you need to know about this program, the ins, the outs, the pros, the cons, and basically answer any questions you have. So this episode was basically a webinar that I did last week, but I'm pulling it and putting it up here because there is so much good information. Now again, as of April 13th, the funds are currently no longer available. However, it's something that you want to continue talking to your lender about. And also know that CALHFA, the organization that brought you this loan, also offers a bunch of different type of home buying assistance programs, which are still going to be available for you to take advantage of. So some of them include giving you up to 3.5% down for your down payment, as well as covering all your closing costs. So make sure you talk to a qualified lender about these type of programs if you're thinking about buying a home but need a little bit of assistance with that down payment and closing cost. So let's go ahead and get into today's episode. I will start off by introducing myself. If you don't know me already, my name is Josh Alexander. I am a real estate agent in Orange County. And my co-host, Mina, I'll go ahead and let you introduce yourself as we go through this and wait for some more people to join.
Yeah. Hi, everybody. I'm excited to be here to talk about this program. But yeah, I'm a local mortgage professional in Orange County and Southern California in general, but licensed in all of California and also Texas as well.
Okay, so let's go ahead and get going today. So today we are here to talk about the Dream for All program. So it's probably the most hyped program that I have heard of since I've been a real estate agent. It seems to be what everybody is talking about right now. It's what most lenders are inundated with calls with right now. So I wanted to go through and basically try to get some clarification on exactly what this program is and some of the pros and cons surrounding it. So that way you can figure out if this is something that might be a good fit for you. So Mina, would you like to just kind of go over some of just the very basics of what this program is all about?
Yes. So, I mean, honestly, it's a program that no one's ever seen before. Like, we've never seen this much of an aggressive down payment assistance program before. Like, in the past, whenever we had down payment assistance, it's typically for the minimum down payment and such, and with an FHA loan. And bottom line, this program, I guess to give a quick general overview, it allows you to borrow or get help from the government, state of California, up to 20% of the home's purchase price or appraised value. Now, that 20% that they're letting you borrow when you purchase the property, that money is not just given to you. I mean, unfortunately, there's no such thing as free money. But essentially, it's a shared appreciation program. So the state of California is actually going to take whatever down payment that you got help with. So if it's going to be the full 20% that you got from the state of California, then you have to share 20% of any equity gain or appreciation gain in the property at the time you're selling the home. So later in the future, if you sell the property, let's say you bought a home for $800,000 and now you're selling it for $1 million, that's $200,000 extra appreciation you gained. So on top of the down payment being repaid, which in this case 20% would be $160K, you would also need to repay 20% of that $200,000 appreciation gain, or $40,000 at the time you sell the property.
Gotcha. So this is basically
almost basically a zero interest loan. So you're basically getting a giant chunk of money from the government, sometimes in the change of hundreds of thousands of dollars, to be able to get this down payment for your house, which is one of the hardest things to do, especially in Southern California. When people are renting homes right now, they're spending probably half their income a lot of times, if not sometimes more, on getting these rentals. And that money is just going nowhere. So it's going to the landlord or nowhere else. And it's really hard to save up enough money to actually be able to put down as a down payment, especially when purchase prices in Orange County area are $800,000 for a condo and over $1 million in most places in Orange County for a regular home. It's really hard to be able to save up hundreds of thousands of dollars to get to that 20%. Now, obviously, one of the biggest myths that has pretty much always been the biggest myth in real estate when you're trying to purchase a home is that you need to have 20% down to purchase. However, there are a lot of programs out there that can go all the way down to 3%, 3.5%. So those type of programs are available all the time. But this program, where it's covering the full 20% of your down payment, is just not something you see very often. Now, California has dedicated $300 million to this. So they said it's going to last probably till the end of summer originally. But based on how much this has been hyped and everybody seems to know about it now, I can't see this lasting for more than maybe a month and a half, 2 months. Mina, what are you seeing on your end? Are you seeing a lot of interest from people talking to you about this? What is your kind of perception on how long you think this type of program is going to last?
Yeah, and that's the tricky thing, because so overall, what I'm advising a lot of my clients right now, because it's difficult to time exactly right when the right property will come on the market too, because we're still in a very
Yeah.
low supply market right today. So with
Yeah.
all that being said, the funds that they have allocated, we don't know when exactly it's going to run out. I personally have a feeling it's going to run out in maybe 45 to 60 days. And I don't want that to be a discouraging factor for anybody. For me, overall, with the pre-qualification, pre-approval process, it's no risk to the individual. You at least get to learn about the process and also just understand what the banks are doing when determining what you qualify for, but what the numbers will look like too. But additionally, because this program will shift the numbers quite a bit, right? Whether you're putting 20% down or maybe 5% down if you're coming in with the funds out of pocket. I run the pre-approval calculation for both and basically go through in detail with the client both scenarios. Because depending on the timing, if it all works out where the funds are still available, we get into contract and we can reserve the funds, we can go with this program. But again, no one can guarantee the timing of all of that happening right perfectly for the stars to align. So because of that, I also like to go through the details of what the pre-approval would look like if you didn't have the 20% down payment assistance. And overall, like you mentioned, Josh, there are still so much misconception or so many misconceptions around mortgage insurance and different things like that, that I just really like the fact that more people are open to having these conversations now thanks to this program. But one thing I don't really agree with the narrative of, sometimes I saw on the news somebody talking about this program and they were again kind of demonizing mortgage insurance, like, oh, you don't have to get mortgage insurance because you can get the 20% down. But for an $800,000 property with 10% down, your mortgage insurance payment, if you have a good credit score with a conventional loan, it's like $70 a month. It's not that bad. And so overall, I wouldn't look at this program as an end all be all, but we should definitely move quickly considering the fact that the funds are limited. And if the right property does come about, you don't want to miss the opportunity altogether by not even trying.
Exactly. Yeah. And so let's go ahead and kind of get into some of the details of this program. So, like you kind of stated at the beginning, you can do up to 20% with the loan. So, let's say that the buyer has been saving up some money and they have maybe 3 or maybe 5% saved up. Are they still able to take advantage of this program? Can they use some of the money they saved up as well as some of the money from this program and kind of combine it? Or how does that work? Is it only 20% or nothing? Or can you kind of work it in different ways depending on each individual buyer situation?
Yeah, so the good news is it's actually quite flexible. So basically, even with the whole 20%, you don't have to apply all of that towards the down payment, for example. So if you choose to borrow 20% from the government, you can do a 15% towards the down payment and use the other 5% to account for closing costs and different things like that. Because I will note too that using this program does have additional costs associated compared to just getting a traditional loan. So considering all of that, you still have the ability to not come in with any money out of pocket if you just choose to apply to 15% and maybe come in with the 5% on your own for the down payment and then use the remainder of the assistance towards closing costs and things like that.
Okay. And then the advantage of doing that as well is that you're not paying the full 20% equity when you go sell the property, correct? So if you borrow 10% equity, then when you go and sell the property, you only have to pay that 10% equity as the share program. You're not paying the full 20% no matter what on the back end. Is that correct?
Exactly. But I guess the example that I was presenting is if you still took the whole 20%, but only used
Mm-hmm.
15% to the down payment, but you're still benefiting from
Gotcha.
the
Yeah.
additional 5% for the closing costs. So in that
Mm-hmm.
case, the way CalHFA is going to look at that is you still use 20%, and therefore, yeah, you will still
Full
have to repay
20%.
20% of any equity.
Okay. But if you want to just kind of help yourself out and maybe you don't need all the money or you want to be able to save some equity in the home when you go to sell it, you can take advantage of maybe 5% of this program and not do the full 20. And that way on the back end, you end up paying back a little bit less and keeping more in your pocket, right?
Exactly.
Okay. So can we kind of go into the basics of qualify? So like what is the basics that someone needs to be able to do to qualify for this program in terms of your credit score, what kind of financial situation, who might this be best for in terms of what this loan is meant for on the buying side of things?
Yeah, so they have income limitations and also credit score. Basically, qualifying for this program, it's all the guidelines of Fannie Mae, which is the regulatory agency for conventional financing. So the way we
Okay.
qualify the borrower with their income and everything is still the same. So of course, just because you can qualify for the program, it doesn't mean you can buy whatever price of the home you want. You need to
Yeah.
qualify for that house based on
Yep.
conventional loan guidelines. But for this program specifically, so credit score requirements going to be 660 minimum, but for most individuals in a certain income, the 660 minimum is for lower income borrowers. But I think
Okay.
realistically in Orange and LA County, any of the higher cost areas, most will fall into the higher categories. So the minimum credit score is going to be 680.
Okay.
Now, overall, when it comes to qualifying, you do have to be a first time home buyer, but I do want to kind of note their definition of a first time buyer because it's kind of interesting. It
Yeah.
doesn't sound like what it should be, the definition,
Yeah.
right? You would assume that if you ever owned a property in the past, then you can't qualify as a first time buyer. But their definition is so basically, all borrowers, including co borrowers, must reside in the home and meet the definition of a first time home buyer. A first time home buyer is defined as a borrower who has not had an ownership interest in any principal residence or resided in the home owned by a spouse during the previous 3 years. So basically, as long as you haven't had ownership interest in a home that you've lived in the past
Yep.
3 years, then you're, yeah, ironically, technically a first time buyer.
So first-time home buyers or someone that hasn't owned a property in 3+ years can qualify for this type of program.
Yeah, but also, I mean, if somebody owned maybe like a random property in the Midwest and they bought that as an
Mm-hmm.
investment property years ago, but they've never lived in it and they still own it. Even
Yeah.
if they
Okay.
still own it, they actually would still qualify as a first time buyer as long as we can prove that they've never lived in that address.
Okay. So 660 minimum, 680 is definitely where it's probably going to fall into in terms of credit score. They have to meet the minimum qualifications for the wages as well. So when Orange County, offhand, do you know what those are?
Yeah, so Orange County, I'll mention kind of the few Southern California
Okay.
counties that may be applicable, but LA County, the income limitation, this is gross income, is 180,000. Orange
Okay.
County would be 235. Riverside and San Bernardino is 173,000. So they're actually quite flexible in terms of the income
Yeah.
limitation.
Okay. And just to be clear, that income limitation is not per individual, but per household or anybody that's going to be on the loan. Is that correct?
Exactly. And then another thing I'll note too is when it comes to the income limit, so let's say somebody's W-2, they're buying in Orange County and their W-2 show a gross income of 250,000.
Mm-hmm.
Now, that's technically above that income limit threshold, but what if that individual had a base income of 180,000, but then they
Okay.
receive commission or bonus or those kind of variable type income on
Okay.
top? If that's the case and we don't need that additional income for qualifying purposes, we can actually just simply go off of their base salary income and then they would
Okay.
actually meet that income limitation in that sense.
Gotcha. Okay. So there are ways that you could possibly go slightly above that depending on how your salary is structured.
Exactly. If your base income is 250, then there's no way.
Okay.
But yeah, in certain circumstances, if it's variable income involved and we don't need to include that, then we don't actually have to.
Okay, perfect. So we have the minimum credit score, we have what you need to be making or under to be able to get in here, first time home buyer or haven't owned a home, primarily home, for at least 3 years. And then the last qualification is they need to be able to take home buyer counseling classes, correct?
Home buyer counseling classes, yes. So
Okay.
they have links all located online. And of course, if anyone's interested in proceeding with it, then of course I'll send you the link directly too. But once you complete the course, then you'll just have to have a one-on-one counseling session with a representative from CalHFA. And this is mainly for the purpose of making sure you're fully understanding of what you're getting into and
Yeah.
how exactly the program works and what the shared appreciation would look like in the future. So those are the main requirements, but overall, a few additional things I would like to know is, unlike any traditional loan where you can have somebody who's not going to actually live in the property co-sign on your loan and help to
Hmm.
qualify, this program does not allow any non-occupying co-borrowers.
Okay, that's good to know.
So even the
Okay, so
spouse,
no
believe it
parents
or not,
calling.
yeah,
Yeah.
if like let's say we only used one spouse to qualify for this
Okay.
program, even if the other spouse wants to be on title to the property, they cannot. Only the person
Okay.
applying for this specific loan can be on title. And this is not true for all other traditional loan products. This is specific to CalHFA Dream for All.
Okay. So let's go ahead and kind of get into some of the, actually, before we do that, if anybody on here has questions, feel free to put them in the comment section. And as we go through this, we'll kind of answer those as well. And then we'll also have a Q&A at the end. So if you have any additional questions, we can also answer them then, but feel free to put them in the comment section and we'll kind of get to them as we go through this. So let's go ahead and go over some of the pros and cons of this program, because obviously with every program, you're going to have some things that are good and some things that are bad. So let's go ahead and start with the pros first. So, I mean, from the way I look at it, obviously the number one pro is it helps home buyers who make a decent amount of income and maybe can afford a mortgage, but just haven't been able to save up that money for a down payment. It helps them kind of jumpstart their home ownership, get them into a home a couple years earlier by helping them out with this down payment. And then they can kind of eventually go sell their home, upgrade if they want to later on. But this gets them in a home, building appreciation a little bit sooner. So is that kind of the primary benefit that you see as well?
For sure. Yeah. I would say, I mean, up to 20% down payment assistance. I mean, there's no other program like it. And
Yeah.
so in general, that's the main pro of this program, and all
Okay.
I guess compared to other down payment assistance type programs too, I mean, the rates aren't too much higher, and I guess on that note
Okay.
too, friendly reminder, rates are very specific to CalHFA, so the rates for conventional loans generally don't apply to this particular program. We have to lock the
Okay.
loan with CalHFA specifically.
Okay. So in general, you said they're a little bit higher. Do you have an idea of how much higher than this kind of a standard loan that you're looking at with this program?
Yeah, I would say actually they're pretty comparable. It depends on the bank
Okay.
and lender you're working with too, but at least for us, our rates are actually lower than CalHFA by
Okay.
about 0.375% today.
Okay. Got it. And then in terms of other pros in this, so obviously, if you're able to put a full 20% down, like you talked about before, you can get rid of the PMI, so private mortgage insurance. So if you have less than 20% down on a property, you need to be able to pay that in order to get into the home. So this eliminates that. Like you talked about, it's not a giant amount, but it does help out if you want to be able to reduce your mortgage as low as possible by putting that full 20% down. So that's another benefit that I see on that side of things. And then third, I mean, compared to a lot of the programs out there, because there are a lot of programs and even programs that CalHFA offer that will give you assistance 5%, 10% down. But a lot of these are going to be programs that you basically have to have like almost like a secondary interest rate on. And it's not an interest-free loan all the way till when you go sell your house. So this program specifically, I think one of the other benefits is you don't have to worry about paying interest on $100,000, $160,000 worth of money. Just basically sits there, works for you, and you can really leverage that money to be able to build some wealth, because when you go and sell your home, let's say 5 or 10 years later, and it did appreciate $200,000. Yes, you have to pay back a little bit of that, but you're getting a lot more than if you were renting for the last 3 or 4 years
Exactly.
and just basically flushing your money down the drain, trying to save up for that down payment instead. Is that kind of another benefit?
Yeah, for sure. I think overall, that's going to be the main kind of like summary of all the benefits to it. And on top of
Okay.
that, I guess when it comes to how the 20% down payment assistance they're giving you is positioned, they call it a silent second lien. And that's just a fancy way of saying it's silent, as in you're not making payments on it. It's not due until you actually sell the property. So it kind of
Yeah.
chills under your first main mortgage as like if you got down payment
Okay.
assistance of 160 grand, it just chills there, no interest is paid
Hmm.
on it, and nothing is done. So that's actually a huge benefit because usually a lot of these programs, you're right, do charge some kind of interest.
Gotcha. Okay. Is there any other pros that you can think of that you wanted to go over before we go over the cons section?
I would say pro wise, those are mainly, yeah, the main benefits. I would say that's actually, yeah, you summed it up perfectly, Josh, honestly.
Okay. Okay, so now let's go ahead and go over the cons, which is what a lot of people are wondering about and where most of the questions that I'm getting are kind of coming from. So
Yeah, like what's the
maybe we'll
catch?
kind of go back. Yeah, just go back and forth here and we can kind of summarize some of them here. So obviously the first and most obvious one is that you're going to be losing some equity in terms or your profit when you go and sell the property. So depending on how much you take to use for this down payment, when you go and sell the home, you're not going to be getting as much as if you were to put the money down yourself and then sell it and get 100% of whatever proceeds of the sales with. So that's kind of the number one obvious one. On top
Yeah,
of that, I would say on the real estate side of things, one of the other things that buyers would have to worry about, especially as we head into April right now, where it seems like the housing market is starting to stabilize and heat up, and we're
yeah,
starting to see open houses packed again. We're starting to see multiple offers on homes, which seems crazy when interest rates are still above 6% in most areas, at least in general. They're starting to come down again this week. But that's starting to happen. So if you're a buyer trying to place an offer on a home and you get into a multiple offer situation, these type of loan products can be looked at as a little bit more risky compared to just a standard loan, for a lot of reasons. Maybe, Mina, you can kind of go over some of the reasons why these are a little bit more risky when looking at it in a seller's lens when they're trying to decide which offer they want to take, because of some of the mechanisms that have to happen and not being able to lock things in until after you're in escrow.
for
Did you want to
sure.
kind of go over a little bit of that?
Yeah, and I mean, you have to, like Josh mentioned, put yourself kind of in the seller's shoes. If you're in a situation where you're the seller and you've got 8 offers to pick from, out of the 8 offers, maybe all the other offers are presenting, hey, here's proof that I have the down payment for 10%, 15, 20. It's in my account here. And that's something that's not required, but something that you do want to include just to position it as a very clean, put together offer, right? But if
Yeah.
the other offers include that, and then the CalHFA loan offer comes in and they state, well, we're going to get the money through this assistance program, but we can't guarantee we're going to get it until we get into contract. And that's another thing that I
Yeah.
forgot to mention earlier. The way the funds, like how the reservation works of making sure you
Hmm.
can get the money, it doesn't get reserved. Unfortunately, I wish it did. I
Yeah.
would like to think that that would make more sense, but it doesn't get reserved at the pre-qualification stage. So it only
Yeah.
gets reserved once you have an offer accepted on a property. So because there's this additional layer of submission we have to go through for underwriting. So usually we'll have the internal underwriters underwrite the loan. And once we're at
Okay.
the approval, then we send it off to CalHFA is the way the process would work. So but once we are
Right.
able to do all of that, so once we get the offer accepted is when we can reserve the funds. So again, going back to from the seller's standpoint, if they're comparing against 7 other offers where they could show it in their bank right now, we're not going to look as strong possibly depending on the
Yep.
situation, but also the timeline is going to be a little bit more extended because we have to
Yeah.
send it to CalHFA. So
Okay.
for conventional 30-year fixed type loans, we're very quick. Most escrows typically are 30 to 45 days. We can close in 15 days. So
Okay.
there are many situations, even recently, where one of my clients was able to get an offer accepted against literally, I kid you not, 18 other offers because we were able to close as quickly as a cash offer. But if we
Okay.
tried to
Yeah.
push with the CalHFA, then we need about 35 to 45 days to close because of that extra layer. And therefore, your offer may not be looked at as competitively.
Gotcha. Yeah, so that is two things to consider. So one, obviously the seller, if you're in a multiple offer situation, you might have a harder time justifying it. And then number two, if that seller needs a quick close, this is going to be a very hard loan product to use. So depending on the situation, you might have to kind of, basically end up shooting yourself in the foot, because these type of loan products are great as long as the seller's timeline matches what your timeline is. But if they need to sell
Exactly.
quickly and need a quick close, this type of program might not be the best fit for you.
And that's why
Uh,
also, I guess I'll go back to how we
yeah.
run the numbers for both scenarios for this reason. We never know
Yep.
what the situation's going to be with the seller. So at that
Yep.
point in time, I don't want it to be like, oh, too much friction. Who knows if we can even use this program? I'm not even going to try at all. We never
Yeah.
know. It might all work out because there's been situations where it does and all the timelines match up. But by understanding both scenarios, and I think it's also equally important to just work with a lender that's in close communication with you throughout your home search, because
Yeah.
that's extra important in this kind of
Yeah.
environment, especially with a program that's a little bit more fickle and we don't know how long the funds are going to last for. You need to make
Yep.
sure you're running the numbers for both so you're fully aware of what to expect and anticipate in regards to what the payments and everything will look like and even the qualification itself.
Gotcha. So I don't know, because this program just started, I'm not sure if you've encountered this yet or know this answer. If not, we can always look into it and get back to people. But so let's say you place an offer on a home and you do, like you said, kind of also get a regular pre-approval as well as this one. Are you able to go through and get the offer accepted as a either regular pre-approval, pre-approved offer, and then try to get this CalHFA program? And if it doesn't work out, you can continue using that regular pre-approval? Or is it something where you really have to know before you get into escrow which route you want to go because of the timelines involved with it?
So as long as that's the main thing, as long as the timeline works,
Hmm.
then I would say it's doable. But also, I
Okay.
mean, in a competitive situation, most sellers do want proof that you have that money to put down. So if
Yeah.
you're not wanting to disclose that it's going to come from down payment assistance at the offering stage, the question becomes, how do you show that you have it at all?
Yeah. Okay.
And so
So
that
if
might be
someone was
another variable.
based, yeah, okay, that makes sense. Um, So one of the other ones that I want to talk about, because when I heard of this program, it was by far the first question that popped into my head, because where interest rates are right now is, are you able to refinance in this type of product without triggering some type of fee or having to pay back that 20% that you borrowed if interest rates drop and you want to refinance to try to get a better rate and reduce your mortgage even more? Is that something you could still do with this program?
So they did clarify that they will allow you to refinance only one time. So one time
Okay.
before it's going to have to be repaid. And
Yeah.
the one time does have to be done through CalHFA. So again, it's going to be CalHFA's rate sheet, CalHFA's everything.
Okay.
So other aside from that though, I guess kind of going into the cons, I mean, again, you're sharing ownership interest in the property with the state of California, right?
Yeah.
You don't own your own property outright. So that's going to come with restrictions such as refinancing. And also the big benefit with owning your home is you have a lot more flexible things you can do with your equity later. So if
Yep.
your home, grows in value and maybe you don't want to sell it yet, but you want to tap into that equity, maybe invest in another property and pull some money out of your equity, you can't do any of that until that's repaid, the down payment
Yeah.
and the 20% equity share. So
Okay.
those kind of restrictions are something to just be cognizant of and be mindful of, since that wouldn't apply in any other traditional standpoint. And also, I guess going back to Josh's first point, when it comes to sharing and the appreciation, if you were to renovate and improve the property in any way, because a lot of times a homeowner will buy their property and maybe they renovate the kitchen, which does improve the value, or maybe they do some landscaping, anything like that that you as a homeowner choose to do with the property, and that increases the value even more, which should be the goal. That should be the goal
Yeah.
always.
Yeah.
But if your actions did that, the government's still going to benefit from your actions because they're taking 20% of your property's appreciation no matter what you did to it, whether you
Gotcha.
did
Yeah.
things or whether you didn't. So if you spent a lot of money on a kitchen remodel and expect an 80% ROI on that cost, it's not going to be a full 80% ROI anymore, considering you have to give up the 20% to, of course, the state of California at the time of the
Yeah.
sale.
Okay. Yeah, that's definitely a good point to be able to understand that any money that you put in, you have to be able to kind of look at that at a different lens than you normally would, because every dollar you're putting in if you're taking that full 20%, then you're having that 20 cents go back to the state. So it does make it harder for that ROI to make sense on a lot of projects if you're not getting that full money back, because usually on most projects, you're not recouping 100% of the cost of the project anyway. So on top of that, if you're having to give another 20%, you might have to understand that if you're buying a property that needs a lot of work to it, that you're planning on putting a lot of money into it, you just have to know that going in, when you go and sell it, all that work that you did, you'll still get a return from it, but it just won't be quite as much as you might have if you were to put your own down payment down.
Exactly. And also, I guess on that note too, the freedom of what you want to do with the property. Like a lot of times, if you buy a property, you might want to rent it out later and make it an investment property. You
Okay.
can't technically make this property an investment property until you
Okay.
repay that 20% or whatever amount you borrowed along with the
Good to
20% of
know.
the equity.
Okay. Yeah, that's definitely important for the people that were trying to build some long-term wealth and are looking at it as more of a starter home and then renting it out later. So if you don't have that equity
Exactly.
built up, you're not going to be able to get out of that. So if you are thinking of buying a home that you might want to hold on to and then purchase another home later on, you might have to hold on to that home a little bit longer, because you're going to have to wait until you get a good amount of equity, and hopefully rates continue to drop. So when you do refinance and take that 20% out, repay it, that your mortgage rate is going to be low enough still to be able to make sense to rent it out, especially if you're doing long-term rentals, which around this area are hard to cash flow in general. So it's just one more added cost that you have to worry about when you're trying to do that.
Exactly.
I think that's all the cons that I can think of, that at least I had written down about this program. Is there anything else that you can think of con-wise that we didn't go over?
I guess a couple of just side notes. So, yeah, there are additional costs to going with this program. So, it is a higher
Okay.
cost program in general. Even if you're getting the assistance, you're not having to come in with it out of pocket. It still ends up being a
Okay.
cost you're paying. And also, I guess we already touched upon the longer escrow period and things like
Hmm.
that. But
Do
yeah,
you
I
know?
would say
Do you have
those
an
are the main
idea
things.
of how much extra cost it is offhand, or is it just kind of, you just know it's going to be a little bit more?
Yeah, so it just depends on which loan amount category you fall into. Like, for example,
Okay.
within a higher cost area like LA and Orange County, within so they follow conventional loan limits for how much of a loan amount you're allowed to take out. And the
Yep.
conventional loan limits for the higher cost areas, it's very specific. I really never understand why
Yeah.
it's so specific. But it's 1,089,300. Like, where did the
Okay.
300 come from?
Yeah.
But anyway, so that's the loan limit, but within the conventional loan limit of 1,089,300, there's actually a conforming conventional loan category. So basically any loan amount below 726,000, that's a
Okay.
conforming conventional, and anything above that to the actual limit of 1,089,000, that's going to be a high balance conventional. So the reason I'm
Okay.
specifying this is because if you're in the high balance conventional loan amount category, there's an added cost of about 1.7% of the loan, or I'm sorry, 1.4% of the loan amount. And
Okay.
so if the loan amount, let's say, is 900,000,
Hmm.
then that would be an additional cost of around 12,000, a little over
Gotcha.
12,000. So
Okay.
essentially, yeah, that cost would not be applicable for a traditional 30-year fixed type program.
Okay. And that can, I mean, that can be offset by you're able to use some of the funds from it to be able to cover that, but it's an additional cost that you're basically having to
You are
use the
still
funds for, that
paying.
you can't put towards the down payment. Yeah.
Exactly. So that's why, you're gonna have to repay the down payment funds eventually, or the 20%, whatever amount that you even use to cover that cost. And so
Yep.
essentially, long term, you are technically incurring that extra cost is the main
Okay.
thing.
And then one other kind of thought just popped in my head in as well. So if someone wants to take advantage of this and use the full 20% down payment, are they allowed to use that full 20% down payment, and on top of that, bring in some of their own money to be able to make it even more than 20%? Do you know?
Yes, you actually are allowed to, but right
Okay.
now there's some confusion around so we basically had a Q&A session with CalHFA directly, and there was a couple back and forth, and we're trying to confirm exactly, and we can confirm and send out the information to everybody later on. But
Okay.
some of the guideline verbiages state 70% loan to value, which means basically in total it has to be 30% down or less. But
Okay.
now it's been possibly confirmed that you can actually put down an additional, like even 30% on top of the
Oh
20%.
wow.
And so your
Okay.
total down payment technically is 50%, but the 20% is coming from CalHFA. Now it's being confirmed that that is a possibility. But in the
Okay.
past, yeah, some people had thought, because it's strange, the way the guidelines were worded, it
Yeah.
seemed like they were saying the max down payment was 30%, but it looks like there is some more wiggle room on that. But also at that
Okay.
point, if you have an extra 30% on top of the 20% assistance, personally for me, I would much
Yeah.
rather just buy the property, own it
Yep.
outright, have the freedom and flexibility to do what I want with the property without
Yeah.
worrying about sharing it with the government.
Yeah. That probably makes more sense.
Yeah, but it is kind
Okay.
of funny. I've had inquiries like that, like people who have a lot of money in the bank, and I'm
Yeah.
like, "Why are you looking into this program?"
Not the greatest, yeah, and probably find better uses of it. So, before we get into the question section, one other thing I did want to kind of ask and clarify here, because a lot of people using this are often looking for like condos or something like that. So, when you use a FHA loan, a lot of times the condo complex has to be FHA approved in order for you to be able to get a loan in that property. So, with this being more of a conventional style of a loan, does that kind of take that restriction off and possibly open up buyers to be able to look at different areas that they might not have been before if they were using more of like the FHA lower down payment loans?
Yeah, exactly. So a lot of people, I guess, to back up a bit, the loan program, conventional and or I'm sorry, FHA and VA loan, those are government loans, and they actually
Yeah,
have restrictions on which condo communities they're willing to fund loans in. So that's
yeah,
why Josh mentioned that the community itself has to be FHA or VA approved in order to use that loan program to buy in that
yeah.
community. So with the CalHFA loan, it's actually all through conventional. So that means Fannie and Freddie guidelines are what it follows. So it doesn't have to be FHA or VA approved, but it does have to meet all the guidelines in the conventional Fannie Freddie umbrella.
Okay. And that's definitely, especially in Orange County, just from my personal experience looking at condos that are FHA approved versus non FHA approved, there are a lot of condo complexes that are not FHA approved or in the process of going through the FHA approval
Or
or
it's
possibly have
expired.
fallen out of it. Yeah, just got out of it and didn't renew it. And so it really is hard for a lot of people trying to find a condo using an FHA loan. So this is another option that you could use, even if you didn't want to use the full 20% down. Correct. So you don't have to use the full 20% down to be considered a conventional loan. You can use 5 or 10% of this and still be able to look at those type of condo complexes and not have to worry if it's FHA approved or not.
Exactly. So it depends on everyone's situation. Maybe because of one very small detail in the guideline, they had to go FHA. In that case, this
Okay.
program may not be an option. And certain
Yeah.
guidelines, such as, like, for example, foreclosures, bankruptcies, if you have anything like that in your credit history, conventional loans require you to wait 7 years or more. And FHA
Okay.
loans allow you to only wait about 4 years. So if it's like
Oh,
a
okay.
guideline like that where they have to go
Yeah.
FHA, then definitely either way, it's not going to be an option. But you are correct in a general standpoint.
Okay. Perfect. Okay. So, did you have anything else you want to say before we get to the question section?
I think no, I'll probably mention things as I'm answering questions too, but
Okay.
again, mainly for anyone who's interested in the program, I do highly recommend we kind of sit down and talk through one-on-one exactly your specific situation because again, I don't want the cons to deter anyone from this program at all, but I also don't want people to put too much weight on this program where buying a home only makes sense by going through this program. And
Gotcha.
one quick kind of comparison I broke down
Hmm.
on my end, and I can send this over in the follow-up email as well to everybody who attended. But basically, today I ran an $800,000 purchase price scenario at 20% down with the CalHFA Dream for All. Now,
Okay.
using their rates and everything today, the total payment would have amounted to around 4,700 a month, and that's with
Okay.
insurance, property taxes, estimated all included. So then I also ran a 10% down. Let's say you went with a traditional type loan program. And like I mentioned, the rates are lower, at least for us today, compared to the CalHFA rates. So actually, the mortgage insurance, like we talked about before, is around $75 a month. But you could also do something called buying out your mortgage insurance, which is an option I think a lot of people don't really know about. So I just wanted to throw it out there.
Yep.
So conventional loans specifically, you have a few different ways you can choose to pay mortgage insurance. So it's required no matter what if you're putting under a 20% down, but you can go with the monthly option. And the monthly option, you pay that monthly amount all the way up to when the loan amount is paid down to 80% of the price you bought the home at. So eventually that payment goes away. That $70 a month will go away. But the other option would be to pay a single premium at closing. And this is called a single mortgage insurance buyout. Now, the whole concept behind buying it out or not, if you were to come in with this additional cost. So in this case, for a 10% down, and again, if I'm assuming here 2 borrowers with a good credit score, but the cost to buy out your mortgage insurance at 10% down, 800 grand is about $3,400 due at closing.
Oh, wow. Okay.
And it's a tax write-off for that year you buy the home.
Okay.
So if you pay the 3,400, you never have mortgage insurance to worry about. And if we compare having to save an extra 80,000 that a lot of people seem to think to try to get rid of mortgage insurance, with an extra 3,400, you're able to accomplish that. But overall, with the monthly versus single, essentially, if you pay that single upfront, if we actually add up in comparison the monthly mortgage insurance all the way up to the drop-off date, how much that would total up to, that would be higher than if you bought it out upfront. So in the long term, it makes sense, but I'm not going to go too much into detail about that. But anyway, that was a very, very long lead up to the 10% down if you bought out the mortgage insurance with the same scenario. We're comparing again, CalHFA Dream for All total payment estimated to be $4,700. And then if you went with the traditional loan program and bought out your MI, you're looking at $4,975.
Okay.
So that's about $200 a month difference in payment. But when you consider the fact that you don't have to worry about any restrictions around refinancing, and also on top of that, you don't have to pay back any 20% appreciation share later on. It's not as much of a payment increase as I think a lot of people kind of assume in their heads. So just want to throw that out there.
Got it. Okay, so that definitely makes sense. And that's one of the reasons why I had you on here, as well as if you're watching this or listening to this back on the recording. I say it so many times in all the videos that I do when it comes to even thinking about the possibility of buying a house. You're not sure if you're there yet. You're not sure if you're 2 years away. Just talk to a lender. It's free information for you. They're going to be able to run a bunch of different scenarios for you based on your finances. If you're not quite there yet, they're going to be able to give you tips on how to get there and create a plan so you can eventually get there a little bit quicker. So you're not just flying in the dark and have no idea what you need to do to get to a point where you can purchase a home. So if you're even thinking about buying a home, again, even if it's a year, even 2 years away, talking to a lender is never a bad idea, because having that game plan in front of you, knowing exactly what you need to do to get to that point, is so much easier than just trying to figure it out yourself. And it's incredible how everybody kind of thinks that lenders are scary. You don't want to talk to them. When you talk to them, they're going to take all your money or something.
Denied.
Yeah.
No, it's an educational
but they're
process.
not.
You're exactly
Yeah,
right. And
exactly.
I feel like so many people could have bought homes way earlier if they just were open to, and I will say it has to be with the right lender too. I mean, who knows? I can't speak for every human being who's a lender, but if they had just understood what the banks do and what the numbers would have looked like rather than overinflating it in your mind, they could have owned a home and had so much higher net worth years and years ago. So yeah, I always agree with Josh in terms of earlier the better. It doesn't hurt to at least understand how it works, and then you can game plan more proactively and get to the goal quicker.
Okay, so let's go ahead and let's head into some of these questions here. So I'm going to pop them up on the screen. Let's see what we're going through here. Okay, so what if the home depreciates by the time you sell it, or only appreciates very minimally? So that is a very good point. So that is one of the cons that you do have to worry about. So even though in general, over the long run, the housing market has always gone up, when looking at buying a home, whether using this program or any program whatsoever, if you're buying the home for the long term, you're not an investor trying to flip it, I recommend that if you're buying that home, you need to plan on staying there for 5+ years. If you're not planning on staying there for 5+ years, then you have a much higher risk of something like this happening, where let's say the market does continue to go down for the next 2 years and you want to sell 2 years from now and your home is worth 5%, 10% less than it is right now. That could put you in definitely a situation that you don't want to be in, whether using this type of loan or almost any other type of loan that requires like a minimal down payment, FHA 3.5% or even 5% loan. So that is something that if you do down the line sell the property, and it is depreciating, then you could be at a point where when you sell the home, you end up owing money. So this 20% is not 20% based on the home staying at that value or going up. It's that 20% that you borrowed no matter what. Correct, Mina?
Yeah, and so to touch
Okay.
upon that, I mean, 20% down payment you borrowed, that is gonna have to be repaid no matter what if you're selling the property. So Josh is right. If the home value, and I don't really see this happening with the supply levels we're currently at, but
Yeah.
if it were to happen, you have to out of pocket repay whatever amount to meet that 20% that you owe the state of California. But in addition, that 20% appreciation share. So that's actually a really good question, Lynn, because the 20% equity share, that was the question a lot of the lenders had too. Like, wait, what if the home value goes down or it doesn't go up at all? Do you have to like what additional money do you have to
Yeah.
pay? And it was confirmed that you actually, if there's no appreciation gain at the time of the sale, no additional money would be due to them other than the 20% down payment you borrowed or whatever percent down you borrowed. But that equity share part of it, if there's no equity to share, there's nothing you would have to pay.
Now, I'm just thinking of the situation too. If home values go down, I don't think the government is going to pay you that 20% equity that you took out if home prices go down either. So it's something that you do want to consider. Now, in terms of appreciation, typically, in terms of selling the property and making sure that you're at least breaking even, if not making money on the property, I usually recommend that you want to wait until your home has anywhere from 6 to 8% of appreciation built into it before you decide to sell. Because with fees and things like that, that's the absolute bare minimum that's going to help you break even. And then anything above that, obviously, is going to be more appreciation. And at that point, you're just making money. But until your home reaches that 6 to 8%, it's something where you really don't want to sell your home unless you actually have to for some reason. You're moving out of state because of a job or something is kind of forcing you to sell. If you can stay in the property and get at least 8% appreciation, then that will kind of help you get back to the point where you're breaking even. And in general, the housing market in Orange County, Southern California, and the United States in general typically is going to go up in the long term. If you look at even just 5 years, there's a very good chance that 8% you're going to get within that 5-year period. So again, it has to come down to how much you want to own the property or how long you want to own the property. And you have to have that kind of plan in mind ahead of time before you start buying a home that you want to stay in that property and you're able to stay in that property for 5+ years to really reduce that risk. And the longer you stay, the lower that risk is going to get. So I hope that answered your question.
Yeah, and I'll also last thing I want to mention really quickly on that too. I think a lot of people tend to kind of think about the possibility of, yeah, whatever the home values might be in the future when you do sell and things like that. But remember that real estate's not a stock. You know, it's not like you're trying to buy and sell like right away and try to make a profit
Yeah.
right away. In general, I think one aspect that people kind of forget to consider is what would you be doing if you didn't own the property? Like for me, when I was buying my first house, and I'm just very analytically minded, I guess. I just think in equations and math, and I want things to make sense numerically. But what was difficult for me to try to gauge is all the what ifs of what might happen in
Yeah.
the future. But at the
Yeah.
end of the day, for me, I'm like, okay, even in the worst case scenario, let's say if I continued renting, inflation is something people don't consider. The rents continue to go up. You always are going to have some kind of a housing payment, right? And
Yeah.
so how much would that have amounted to? Like even if the home values went down by 20,000, let's say, people
Yeah.
are like, "Oh man, that would suck. I don't want to buy then. I want to buy at the perfect time and hit a home run." But even if
Yeah.
the home values went down 20,000 at the time you sold it, think about the tax benefits you benefited from during that time. Think about the principal
Yeah.
you paid down during that time. And alternatively, how much would you have paid in rent in total?
Yeah.
Hundreds of thousands of dollars? That
Yeah.
20,000 is nothing to cry about. You know what I mean? And so I
Yeah.
think the main focus should always be, are you putting yourself in a better and higher net worth position by making this decision? And that's very specific per individual. But I think if
Yeah.
those things hold true, then it makes sense to proceed if you don't own a home already.
Yep. Yeah, it's really hard to digest if you don't look at it long term in terms of, especially around here. I mean, if you're paying $3,000 a month for your current rental right now, I mean, over just a 3-year span, you're going to be looking at spending $100,000 on rent just in 3 years in
And
Orange
it would have
County. So
most
I
likely
mean,
gone up a little bit, right?
yeah,
Like,
and it
yeah,
would have
no,
gone
it's
up
kind of crazy
exactly.
when you add
So
that in.
yep. So something to definitely consider the pros and cons of continue to rent as well as own on there. So okay, so let's go ahead and get on to the next one here. Okay, so Ali asks, do you pay the silent interest lump sum when selling the property, or can you roll it into the next mortgage?
So silent means no interest and
Yep.
no payments. So yeah, this particular program, the amount that you're borrowing, there's no lump sum interest. They're not charging you any interest on that money.
Okay. And then it looks like, so I think they're kind of also asking if, let's say you borrowed $160,000 for this original property you're trying to buy, are you able to take that $160,000 and then when you go and purchase another property, take that and use it then and not pay it back? Or do you, no matter what, have to pay that back when you sell that property that you use that loan for?
Yeah, that's actually a really good question. I haven't gotten that one yet, but
Okay.
basically, this program is property specific, meaning that
Okay.
at the time you're selling that property that you got this down payment assistance on, that money's due. You can't just take it and move it to a different property since that was allocated for that property. So the minute you are selling that home, that money has to be paid back to the state.
All right. Okay, so let's get on the next one. Okay. Alex, how you doing? I know Alex here. So let's see. If you don't use 20% down, would you drop PMI once we hit the 20% of the home value afterwards?
Yes, so that's just going to work like any traditional loan. So if you end up not using 20% and did 10% down, then whenever your loan balance is paid down to 80% or 20% equity of the price you bought the home at, then the mortgage insurance would drop off. So it just depends. But also, if you make additional principal reduction payments, so instead of just the minimum payments due every month, which amortization wise, your loan would be paid off in 30 years, and the mortgage
Mhm.
insurance drop off would happen in X amount of years, assuming the minimum payment. But if you make
Yep.
additional payments on top of whatever your minimum is, that means your principal balance is being paid down quicker, and therefore you're pushing up how quickly your mortgage insurance payment's going to drop off too.
Gotcha. And then with that, in terms of equity, so in the PMI on there, so if you are borrowing, let's say you're using 10% of this program and you're basically going through, once you get to 20%, including that 10% that you borrowed, is that when it drops off, or do you have to have 20% of your own equity in the property before it drops off, not counting what you borrowed?
20%. Well, another great question. I haven't gotten that
Yeah.
too. But no, it's combined. So basically, whatever down
Okay.
payment, like we'll even take away the CalHFA aspect of it. Whatever you put
Yeah.
in down payment, if you put 10% down, whether that came from CalHFA or not, you just need 10 extra percent to get your mortgage insurance off.
Okay. Perfect. That makes sense. Okay, so let's see. Get the seller. Oh, yeah. So Forrest says get the seller to pay for it. I think that was reference to some of the closing costs and things like that, which is definitely doable. It's becoming less common, unfortunately, over these last couple of weeks as the market's heating up.
Yeah,
But
the
there is
market's
definitely
changing
still,
so much, you guys.
yeah,
That's why
it's
also, I
crazy.
mean, again, realtor and
Yeah,
lender, close communication's important because one
yeah.
week it may have been possible, another week it may not, but it also depends on the property.
Yeah, exactly. But there are still opportunities out there for the seller to pay some of the closing costs as well, especially if they're in a situation where they need to sell. And we're starting to see this more often when they're trying to buy a property and they need to get their house sold by a certain date because they already placed an offer, gotten to escrow. So when those sellers are very motivated, that's usually is going to be the best time for you to ask for those type of seller credits that they're going to be able to give back to you. So it's less money out of your pocket when you go to purchase the home. And I know this is a completely different subject, but it's also a great way to look into different loan programs. And when you talk to a lender, they can go over a bunch of them, not just this one.
Oh my
For
gosh,
instance, the
Josh,
two,
you're like in my
yeah.
mind. I was just about to actually go into that, so keep going.
Yeah, so I'm not going to make this more than an hour long episode here, but things like 2-1 buy downs where you can basically go through and have the seller or yourself buy down the interest rate because they are higher right now for a year or two before it goes back to its normal rate are definitely things that you can take advantage of in this high interest rate environment to be able to lower that monthly mortgage payment and give yourself a chance to be able to go through and refinance later. And I think you and I did an episode on the 2-1 buy downs at
I
one
think
point
we
a
may
while
have.
ago.
And I actually want to mention something really quick about that.
Yeah.
So I just thought of another like slight con with the CalHFA program. So a 2-1 temporary buy down, I think is one of the best programs in the current environment we're in. And I'm sure for
Yes.
a lot of you who follow a lot of people on social media or just have been watching the news, many people are saying, okay, well, rates are higher right now. Yes. But ultimately, the good news is the rates they change all the time. When the rates drop, you always have the ability to refinance. We've seen the rates lower than the current environment many times in the past. So it's realistic to assume that short term, you may benefit from a refinance. So you're not going to be in this mortgage and payment for a very long time in this current environment. But the 2-1 temporary buy down, that basically helps to bridge that gap, because essentially what it does is it's still a 30-year fixed loan, conventional FHA, whatever loan program, it's just paired on top. But whatever rate you're locked into, if you go with a conventional loan, and let's say you're in a 6% interest rate, 30-year fixed, with a 2-1 temporary buy down, the sellers pay for this for you, but year number one, your rate is 2% lower than whatever rate you're actually locked into. So in this case, it would be 4%. Your payments are as if you're in a 4% rate, not 6. And then year number two, 1% less. So that's going to be 5% interest rate you're making payments on. But bottom line, this program helps to alleviate, like year 3 through 30 is when you would actually make the payments on whatever rate you're locked into. But the goal and the idea is during the 2 years where you're benefiting from these much, much lower payments, the rates to drop enough where you can refinance into that lower rate before you get to year number 3 when you actually make the 6% interest rate payments. Now, this program, again, I think is great to bridge the gap to make sure you're comfortable with the payments getting in and try to negotiate something at the time when the rates are higher and not many people may be in the market to buy because they're fearful of the rates. But the CALHFA down payment assistance program cannot pair a 2-1 temporary buy down.
Okay.
So that's just another side.
No double dipping. Yeah.
Yeah.
Okay, perfect. Well, I think that looks like all the questions that we have. So I think that pretty much wraps everything up that we were talking about. If anybody has any additional questions, let's see, Mina's Instagram handle is right there. Mine is right over here. So feel free to follow us on that. That's probably the most active platforms that we're both on right now. So if you want to get a hold of Mina to be able to go through and ask her some more questions, go through that free pre-approval just to see what type of loans you qualify for and if it makes sense for you to buy right now, or if you need to wait a couple years, get that game plan going. And then if you have any questions about the real estate side of things on what it looks like to buy your first home in today's environment, obviously feel free to reach out to me anytime, but follow me on Instagram and I'll be putting out weekly tips and advice every single week to kind of keep you updated on what's going on. So thank you everybody for joining us, and I hope to talk to all of you real soon. Thanks everybody.
Yeah,
Bye.
thank you everyone.